Welcome back, everyone, to Vox Markets. My name is Paul Hiller. I'm delighted again to be able to speak to CEO Sandy Chahar and CFO Suzanne Smith of Supreme, a leading distributor, licensor, and owner of FMCG products across vaping, drinks and wellness, and electricals. So, welcome, guys.
Morning, nice to see you.
Morning. Thanks for having us, Paul.
Yeah, well, it's great to see. Lots been happening in the business, and big congrats on this morning's positive and in-line FY25 results. But there's lots been happening, Sandy, over the past 12 months, not least the two acquisitions. We had Clearly Drinks in June last year, followed up with Thai Food Tea in November. And then more recently, we've had the ban on disposable vapes. So maybe we can just take a step back and you can just remind the audience what sort of Supreme is aiming to achieve over the next 3 to 5 years in terms of its structure and balance between non-vape products and other brands.
Yeah, so I mean, people that don't know Supreme, we're a fast-moving consumer goods business. We're a main manufacturer, brand owner, licensee, and distributor of batteries, lighting, vaping, wellness, tea, drinks. And I think that part of our strategy is to grow the business organically, 4-5% every year, and have acquisitions that increase the business 4-5% every year, and have a nice blended 10% growth by acquiring and having organic growth in FMCG categories that fit in with our with our portfolio of products, and more importantly, our customers that they sell those products.
Good. And just in terms of how those, I mean, I understand they're affordable FMCG products. How are they fitting in with the consumer budgets at the moment, given we've had the cost of living crisis and difficulties in people making ends meet?
Yeah, I'd say like 80% of our products are sold below £2, even below £1. So there is caters more for the lower end of the spectrum, which is much more defensible than the premium or the higher end. And so I think that we're in a very good space if there is a consumer recession or downturn. So that way, Supreme has always been quite defensive stock in those purposes.
Yeah. And then just in terms of the vaping products, I mean, I looked at the results, and I think vaping currently is roughly around about just over 50% of sales. Given the actual disposable vape ban, which came into force on the 1st of June, how did that play into the destocking heading into it? And also, how do you see it going forward?
Yeah, so Suzanne will cover the numbers, but we've been very, very cautious in terms of not having too much stock at the end. We've started to transition retailers about a month before the ban. So as you can see, our numbers dropped on vaping, and that's purely timing around the disposable going and the new products coming in. I mean, if you think our year end was end of March, the ban was end of April. So you can imagine the difference of destocking. However, the first quarter has come out to a really good start on the transition from disposables to pods. And I think we're in a good space in that area. But you've got to remember now that every time we make a sale for a pod, we're getting twice as much liquid. So the consumer has now more liquid for the same amount of money. However, there is a big transition over to bigger puff devices, which are a higher retail point, which is making that balance a little bit better. But Suzanne maybe can cover the numbers in that shortly. But transition wise, I think we're in a good space. I think we've done quite well.
Okay, fantastic. That's a good segue to Suzanne for the numbers. If you want to take us through the key highlights there, Suzanne, and also anything adding on to that vaping with the transition going forward.
Yeah, I'll pick on the vaping piece actually, first of all, if that's okay. Because the headline you'll read is that our vaping category overall went backwards this year. We did 140 million across our two vaping verticals in the prior year and did 130 this year. However, the important thing to note there is that the element of disposables. If you take the disposables out of that, the core underlying vaping category actually grew 8%. EPOS is up with retailers. Our 88 vape 10 ml kind of hero product continues to do really well. Our lines within the prisons that we've talked about a number of times, that continues to go from strength to strength. The only element within the category within vaping it is disposables, and that was a real conscious pull away from disposables as we walked into our last quarter to make sure, as Sandy said, we were being a responsible manufacturer, responsible supplier into retailers, that we weren't contributing to having an abundance of stock when the ban came in, because that wouldn't be helpful for anybody, least of all us. So there's a definite conscious move away from disposables in that last quarter. Overall, another really pleasing set of results. You'll see that revenue's up 4% this year, underpinned obviously by our acquisitions, which I know we're going to come on to talk about, but even the core business away from our electricals category, as I said, vaping's up, and our core wellness category was up as well, which are our key drivers for growth. EBITDA record levels up to 40.5 million, up 6% year on year. Gross profit as a percentage of sales also up 29%, up to 32, which is a real indicator towards our shift into manufacturing. Both the businesses that we've acquired in the year have manufacturing capabilities, and we'll see more of that in FY26. But that just really helps sort of mix and sort of blend on gross margin. And then cash as well. We've had an exceptional year in terms of operating cash that we generated. And we end the year once again on an adjusted net cash basis as opposed to net debt. Now, we report our net debt, and we report an adjusted net debt. The adjustment is only for our IFRS 16 leases. There's no funnies within there. And so despite the fact we've spent over £25 million buying businesses and fueling sort of longer term growth, we've still managed to end the year with cash in the bank. So that's another clear indicator of how cash generative this business continues to be. So yeah, all in all, a really positive set of results.
Yeah, I would highlight to investors, just have a look at that, the cash flow statement, and then the operating cash flow came in at 25 million, which on a market cap of 235 million is a 10% cash flow yield. So it's a real money spinner, Supreme, doing very well in terms of managing its working capital and its capex. Just returning to that gross margin, Suzanne, are you seeing any benefit from the strength of sterling against the dollar? Because in buying maybe stuff from abroad, or freight, or forex, or something like that, is that also helping sort of like margins?
It definitely does. Remember that we do buy in dollars, but we manufacture in the UK, we buy from Europe, we buy from the Far East. So we are not overly reliant on any one of those kind of macro factors, whether that is shipping rates or dollar rates. Don't get me wrong, both of those are kind of swinging in our favour. We'll see more of that in FY26 because we buy forward our dollars kind of 6-9 months in advance. So yeah, they're all helpful sort of tailwinds for us as we move forward, but we're not. When they're good, that doesn't mean our business takes a huge uptick. And likewise, when they come against us, there's lots of other elements as well within the business that contribute to mix. So really, the gross margin being up year on year is a mix of two things: increased manufacturing as a proportion of our overall business operations, and scale. Each year we get bigger, and each year we're able to buy better.
Yeah, no, it's that flywheel effect, definitely.
100%.
Suzanne, do you think it's worth just explaining a little bit the change in our reporting and why we've done it in terms of how we report in our categories? Because I think people should know why that is, really.
Yeah, good point. So you'll see that we previously would disclose our revenue and gross profit down to our individual segments. At the end of last year, we had 5 segments. Fast forward to the end of this year, we have 7. It becomes a little bit unwielding to walk through every single one of those 7 categories. So what we've decided to do this year is consolidate those into 3. So our previously known batteries and lighting category now becomes electricals, which, to be fair, they display a lot of the same tendencies in terms of they're not strategically in our sort of core growth plan, so it's easy for us to kind of keep them to one side. Vaping and branded distribution, we've always kept separate on the basis that branded distribution, we didn't know how long this was going to be around. We didn't know how long we would be the distributor of choice for some of these big vaping brands. However, that's a real solidified sort of cemented relationship now, so it makes sense that now we're through the disposable vape ban, that we amalgamate all of our vaping operations together. Lots of people have asked us, okay, so just tell me in total what is our exposure to vaping. Now we report it as one number. And then our drinks, so we bought a soft drinks business in the year and a hot drinks business in the year. It made absolute sense to consolidate the results of those, and also the crossover into our wellness category, which we'll see more of in 26 with innovation. We're managing that as one category internally, so we're going to report that as one category going forward. We'll still report revenue and gross margin for those 3 segments, but this really alleviates some of the pressure we were getting from kind of competitive threat. We were being perhaps a little bit too transparent with competitors. We were making life a little bit easier for them. This reflects how we're managing and planning our business internally going forward. So it made sense for us to reflect that into our external results as well.
Yeah. And what is that split between vaping and non-vaping products? Is it about a 50-50 turnover going forward?
Yeah, so the year we've just finished, the 140 million was just like 55% of our revenue. But don't forget, we've got a full year of soft drinks and hot drinks going into FY26. So we'll see that that blend move even more in the favour of non-vaping going into FY26, subject to whatever happens with M&A, of course.
Brilliant, fantastic. Then Sandy, just in terms of the consumer for vaping, given we've had the changes of disposable vapes, does it really, frankly, make much difference to the end market demand for vaping products? It's just the consumers are moving from one disposable product onto rechargeable, so therefore the suppliers and the providers of vapes are just basically giving them a different product, but the end demand for vaping is still the same. You're not seeing people giving up vaping.
No, certainly not. I mean, they're literally transitioning over to the new products as if nothing has happened, to be fair.
Yeah, good. And then what about just update on the 2 acquisitions, because they really have been transformational in terms of not only the top line, but also the diversification. First of all, the Clearly Drinks in June last year, and then the Thai Food Tea in November.
Yeah, I mean, in terms of Clearly Drinks, the acquisition's going really well. We've started innovating in Supreme. We've licensed Totino Lamborghini as a license for energy drinks. We licensed with FC UK as an energy drink. We're bringing out Thai Food iced tea. We've got lots and lots of own label going in Supreme customers, in the discounters, in flavored waters and energy drinks that are coming through. But we're not seeing that come through till maybe September, October, November. We're going through shelf life testing on a lot of our products at the moment, on these products, on these new innovations. So it's going well. And plus, you've seen the summer how warm it's been.
Yeah.
So the drinks business has probably, I think, last month had its record month in 100 years in terms of revenue, profits, and number of bottles or cans made. So in terms of Clearly Drinks, is clearly doing well at this moment in time. And Thai Food Tea, we've now manufacturing in Gloucestershire. We've got our own factory. We are applying for BRC accreditation. As soon as we have that, we're able to make private label for supermarkets or other own label brands. And we are looking at streamlining. We have streamlined the business, and we're looking like to actually automate more into the factory with robotic arms and make it more automated. But yeah, I mean, overall, it's only December when we bought Thai Food Tea, so we're only very, very new. And it's only our anniversary of Clearly Drinks. Again, very new. It's only 1 year. Yeah.
So now just moving to the dividend there, Suzanne. I suppose you could just quick thoughts on the increase and also the synergies from, if you've seen whether those are coming through from the 2 acquisitions.
Yeah, the synergies across both acquisitions actually, but and different in both. So remember that Clearly Drinks on a standalone basis was a growing, profitable, cash generative entity. So there wasn't the same need for kind of overhead synergies or alignment to make the business kind of more profitable. It was performing really well on a standalone. The synergies there are more operational in terms of manufacturing. These guys are best in class, highly automated, highly accredited manufacturers. Supreme actually is looking to emulate a lot of their operations. So there's definitely a sharing of knowledge and a sharing of experience in that direction rather than what we would typically see in an acquisition. The other synergistic benefit is that they have this incredible capability, and we have got all of these customers that would love to be involved in soft drinks. So you combine our customers with their product set and a combination of the innovation sort of mindset. That's where kind of the combination of these 2 businesses better than them as individual operators. On Thai food, there is much more of an overhead play. You know, the businesses, I think we talked about a lot at half year, the business was loss making, so it needed, you know, an overhaul of its overhead base. We've done exactly that. There are a very modest amount of incremental overheads that we took forward with the business versus the business on a standalone basis. And as well, then we have done things, we've retained all of the customers as well, which is a really important factor. And we've restarted UK manufacturing. So whereas the previous owners were buying from third party, we've been able to take some more of that margin for ourselves by, you know, stepping back into the supply chain, which is something that we've seen Supreme do in lots of other acquisitions. So yeah, much synergistic benefits are much more sort of overhead leverage and bringing in-house manufacturing. So the synergies on both, albeit not quite the same. So both acquisitions, as it stands, are doing financially and operationally exactly what we intended them to do.
Brilliant. And then, so putting all that together, Suzanne, what's the sort of the outlook for 2020 FY 2026 in terms of how you see the business shaping up?
So we've got a full year of both the acquisitions that we did last year, so for Taifu and Clearly, which, you know, standing still, that gives us a platform for growth. We are, however, still going through this very transformational change from vaping to from disposable vapes to, you know, kind of the rechargeable devices. We're just at the start of that journey. As Sandy said, we've had a really positive Q1, and we need to see how that unfolds. We also, you know, let's not lie. It's a difficult market economically, and discount retailers so far appear to be really performing well, which means we do. But at this point in the year, we're always cautious. You know, we've got 9 months to go. There's a lot of change. But our M&A pipeline is really buoyant. The 2 acquisitions are performing really well. We have scaled manufacturing right across our group now and our warehousing operations. That means that we are really ready and poised for growth. We continue to be backed by a very strong balance sheet. You'll see that we refinanced during the year, which is a nod really to our ongoing appetite for M&A. And our customers are continuing to do well. So we've got all the right factors there. I think if you know Supreme, especially at this time of year, we just like to exercise a bit of caution when we are managing expectations of investors or analysts, and we like to grow into our performance during the year.
Yeah, well, I'm certainly looking forward to trying out your new Lamborghini energy drink, that's for sure, later on. So just finally, Sandy, I don't suppose you could just sort of any quick sort of closing remarks for investors of
Yeah, I mean, it's business as normal.
Yep.
I think just one thing you didn't touch on is the dividend as well that we've just announced. So Suzanne, if you want to just cover that. But from my point of view, business as normal. I'm looking for deals all the time to grow this business as fast as I can.
Yeah, dividends up 10%. The business continues to generate cash, and we're sharing what we think is a appropriate amount back with investors, holding back as you know a good portion of that really for M&A, because that the pipeline that we've got there looks really interesting at the minute. We've had 2 good acquisitions in FY25. We typically do 2 a year. We don't see any reason for that to slow down. So, you know, that's why we keep some of it back. But yeah, the dividend is a nod to the ongoing expectation we have for 26 and the cash we've generated historically.
Brilliant. Okay, well, thanks very much, guys. Best of luck in the next 12 months. And if you repeat the amount of sort of big strategic steps over FY 2026, then the business will be significantly further ahead from where it already is. So,
Yeah.
thanks, guys.
Thank you very much. Thank you, Paul. Thank you.